You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose and the Loose. Welcome to Retirement Friday. Today, we're going to take a look at three of my favorite income products for retirees. So, I know you retire and the ultimate reflex is to create a paycheck from your retirement portfolio. So you want to, you've worked all your life and then you want to replicate the same model. So like every month or maybe every 2 weeks, every week, you want to generate a flow of income that is being deposited into your account. And then you're thinking, how can I do that at retirement? How can I do it in a safe way? So that's the most important thing. So yes, income is important, but the safety of that income is even more important. And one thing that I see often is retirees focusing on higher yielding products. That could be pretty much everything. But the point here is there are two things actually. The first one is there's no free lunch in finance. I have to tell you, there is no free lunch in finance. If an investment product would guarantee you a 8% or a 10% return every year and not hurting your capital and still paying you that 10% all the time for the next 20, 30 years of your retirement, well, that would be a perfect product and we would all jump on it. But I haven't yet to see this product. So there's no free lunch in finance is the first thing. And the second thing is, from a financial planning perspective, if you intend to withdraw 8% of your portfolio, I don't mind if you're telling me, yeah, but I have investment products, they generate 8% yield, so I can withdraw 8% of my portfolio, investing in those. You're going to deplete your portfolio at one point. You chances are, from a financial planning perspective, when you run simulation with the market and everything, withdrawing 8% of your portfolio is putting your retirement at risk. If you do that, there is a very, very high chance that you're going to deplete your portfolio and you're going to survive your portfolio. In other words, there's a very high chance that you're going to wake up one day, maybe at 75, maybe at 82, and your portfolio will be close to zero, and you will not have an income source from that investment account anymore. That is super important. So regardless of how you invest, if you have a rate of withdrawal that is 6, 7, 8%, even at 4%, sometimes we have the rule of thumb, the 4% withdrawal tool, thumb of rules. It's a lot of times you can put your portfolio at risk, at 4%. So imagine at 6, 8, 10, definitely a big thing. So again, no free lunch in finance. And recently at Retirement Loop, I've reviewed 20 income products with pros and cons. And I did not bring my thoughts on them. I actually stated the facts. So I wanted to be very neutral. Out of those 20 products, I wanted to cover 3 of them today. Of course, the show is 10 minutes. I don't have that much time. So the first one is laddered bond ETFs or GIC ladder. So the two are same principle. So the easy way is to buy a laddered bond ETF because you don't have to do anything. It's professionally managed and it's done for you. If you want to get into it, you can do a bond ladder or a GIC ladder. What I like about this one is super simple because you invest let's say you have $100,000 that you want to put into fixed income. So you put $20,000 for each year of maturity. 1, 2, 3, 4, 5. So that's how you build a bond ladder or a GIC ladder. At the end of the year, you have 20 grand that comes to maturity. Take that 20 grand and you reinvest it for another 5 years. So it helps you to get the best rate possible over the long term. Some investors benefited in 22, 23 of higher rates. They were super happy. But if they were in a cash account or money market funds, now you see the interest rate is slowing down. When you have a ladder bond ETF or a GIC ladder, The advantage is it's super simple and it gets you like a little bit higher rate. It's safe, it's reliable, it protects your money, similar to the cash reserve. So all of those things I really love, and it's still relatively liquid. I mean, the the ETF bond ladder, it's just you can sell it whenever you want. The bond ladder or the GIC ladder manual, I mean, yes, you can sell it, or sometimes you have to wait, but at least once a year you have money that comes to maturity where it goes the liquidity part. The major downside, I would say, if you do that in a non-registered account, you're going to get fully taxes on the interest. So that sucks. Like, it's not perfect. Of course, nothing is perfect. As I said, no free lunch in finance. So that would be the major disadvantage. Or thinking that if you buy a ladder bond ETF, that the money is 100% guaranteed. I mean, it's not exactly how it works. So you have to review fundamentals for investment. If you believe that a laddered bond ETF will always preserve the value, it could change from time to time. The second income product that I really love, like today, and I will continue to love it as a retiree, because this is definitely something that I'm going to keep on using, dividend stocks. Yeah, big surprise, right? I'm going to go quick on this one because obviously we keep talking about dividend stocks here. But it offers a great balance between growth and income. So you have capital returns, you have dividend income, you have like a robust set of metrics to analyze. You invest in quality companies, which is great. A lot, like most of the time, dividend growers and initiators, so company that starts to pay a dividend and increase it after that year over year, well, they tend to outperform the market. They tend to do it with less volatility, which is really good because you want less fluctuation in your portfolio as you're retired. So those are like ticking a lot of boxes. A little bit better for taxes because you have a mix of dividend that is already less tax than interest on a bond or a GIC. And also you have a portion of capital gains that is not only less tax, but not taxed right away, can be postponed in time. So that's great. The downside, well, dividend cuts, obviously. It also requires either more support, so register to an investment website, a membership website, a newsletter, or more knowledge, or both of them to like analyze, select companies, manage a portfolio. Not everyone wants to do this, so not for everyone as well. That would be the biggest downside. That leads me to the number 3, actively manage ETF. If you don't have the time or the knowledge, and especially not the interest, because I mean, if you have time, you can and interest, you can learn. So you can register to membership websites, you can like watch YouTubes, you can listen to this podcast and so on, and start to build your own investment strategy. If you're not interested by that and you want to keep it simple, and this is what I'm thinking of doing once I do not have the intention of managing my portfolio anymore. So maybe when I'll be in my late 70s or in my 80s, and then I will be thinking a little bit more about my wife who has no interest whatsoever in managing a portfolio, well, then going for an all-in-one ETF would be perfect. Low fees, high performance in the sense that you have like great diversification managed by professional. You can have like one line in your investment account that does it all. So that's just amazing. You can have like a portfolio that's like half in bonds, half in stocks, being rebalanced all the time. And then you can just sell units of that single ETF, and that single ETF will invest in like thousands and sometimes tens of thousands of holdings. So in terms of diversification, you don't need more lines. So that's amazing, and this is what I would select to create it. Of course, in the disadvantages, well, you have market risks. It may be tough if you want to combine more than one ETFs, which is usually the case. A lot of investors are thinking that one ETF is not diversified enough, and then they had like 5 to a dozen of ETFs. But then if you're trying to know what's your global asset allocation, sector allocation, it's really hard. You may have duplicates. It's also difficult to, I mean, you need to build an Excel spreadsheet to find it up. So that's why I would go for an all-in-one ETF instead. And of course, you won't have the famous yield that you are looking for. I mean, even for dividend stocks or actively managed ETF, it could be hard to generate the yield that you want. Maybe not like a 4 or 5, 6% yield. Maybe it's going to be too much. But again, want to go back to that lesson that there's no free lunch in finance. And if you want to withdraw 5, 6, 7% of your portfolio per year, your retirement plan is in danger. Like literally, that's for sure. maybe though you want to look at other types of investment products such as tontines or covered call ETF or mortgage investment corporations, well, I've covered them all in a free guide that I've put together. I covered 20 income product for retirees, and you can download the full guide for free at moosemarkets.com/retirement. You'll see they're like one pagers with like star ratings, the pros, the cons, the common mistakes on 20 income products. Just have to go on moosemarkets.com/retirement. You'll be able to download the full guide once you subscribe to the newsletter. I think it's going to help you a lot making better investment decisions. All right, Moose, that's enough for today. I hope that you will have an amazing weekend. I'm driving to Victoriaville for my fellow Québécois. For a hockey tournament, so it's going to be nice. And yeah, so enjoy your Friday, and we're going to talk again on Monday. I'm going to review Labrador Iron Ore. Ironically, a safe high yield. It's going to be interesting to talk about it. So stay tuned and stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.